Joining me now is CNBC contributor FundStrat's Tom Lee. Tom, it's great to have you react to the president and what's happening in the market. So a framework to a deal, no force, all is well now for the bulls?
Scott, I think so. You know, I'd say on Monday morning before the open, I think investors were very concerned about Greenland and what's happened in Japan. And they thought of 2025 when it took 8 weeks for stocks to find their low, down 20%. So I think there was a lot of fear. So today's news really does do a lot to diffuse a lot of that anxiety. And I think it's wise to buy that dip.
Yeah, I mean, as part of this, of course, the president also saying no tariffs on Europe on February 1st. And that's what really upset the market. Are you still looking, though, Tom, as positive as you might sound for a bear market sometime around mid-year?
That's right, Scott. I think we have been pretty clear that we think that there is going to be a mid-year hiccup. It could be around policy or it could be around the new Fed being challenged. But that's coming from us markets being at a higher level. And I think one of the mistakes people make whenever they hear that commentary is they think it means to go to cash now. As you know, we've advised to stay invested and to buy the dip. But yes, there is a lot of good taking place in 2026, but we do have a lot that's already been priced in because of 3 good years of market gains.
What dip would you be buying specifically?
Well, for instance, I would be buying the dip on companies that have good earnings visibility or a structural reason to be long, because those that got sold yesterday, for instance, they're still the same great company. They were just 10% cheaper. I mean, to me, that's a stock I'd want to buy. The names I'd want to avoid are companies that are in the bullseye of White House policy, because we know last year, the White House picked winners and losers. It created problems for healthcare and consulting companies. This year, it's credit card issuers, institutional buyers of single-family homes, and it's, some countries too. So I think that's the stocks to avoid. But I think fundamentally strong names, you still want to buy the dip.
I mean, it's complicated, though. You say that. You don't know who's in the so-called bullseye next. That's one of the problems.
100%. You're right, because if the White House decides that there's a company or a series of companies that are creating problems for Americans right now, whether it's credit card bills or electricity bills, there could be action. As you know, one of the potential, quote, risks is data centers and their consumption of electricity. So that is something to watch.
I mean, you're gonna say, don't buy the home builders, because what if the home builders, he doesn't like home builders building homes and charging the prices they're charging? I'm just saying it's a slippery slope to start going down, where, in your words, you have an administration picking winners and losers. It certainly complicates the picture a bit, doesn't it?
It does, Scott. I mean, every administration picks winners and losers. Tom Block, our policy strategist, has pointed out that's what Washington's habit is, that they tend to pick winners and losers. But we do have a White House that is quite ambitious. They've accomplished a lot, but they're trying to accomplish a lot. So you're right, that's the risk. And perhaps one of these is enough of a tipping point to cause a broader pullback in markets. I mean, that's another possibility for why we'd have a drawdown that feels like a bear market.
But you still feel as though whatever upset we see or feel is going to be reversed and we end up having a pretty strong year?
Yes. In 2025, that 20% decline did not lead to a recession. And as we pointed out, that since 1950, waterfall declines that are not followed by a recession, and particularly a VIX hitting 60, have been symmetric recoveries. So I think if we have a, 6-week drawdown, investors shouldn't sell, because unless they're great at timing, we can recover all of that loss within 6 weeks. And we are expecting a really strong finish for the year. So, Tom, I think it's just...
Where does the Fed factor in to all of this? You heard the president with his obvious criticism of the current chair, Jay Powell, and some commentary on where the next chair may come from. How much does this matter to your outlook?
It's important, Scott. The Federal Reserve is the single most important entity in the world, and its independence is incredibly important because markets respect the Fed and they actually fear the Fed. So the independence matters. I think the process, and Steve Leisman made some good points, I think we're at odds increasing that it's the Fed that'll be respected because the multiple things taking place at the Fed now kind of limit how the White House can proceed to pick the Newport chair. And actually, that's probably a good thing.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
So, I mean, if you take a look at the bond market, the cues there seem to be shifting to a concern about growth, concern about longer inflation. Where do you stand on all of this?
So I do think we're going from a price shock to a price shock and a demand shock. And that's the economic logic of all these tipping points that are being triggered in the war. I must say I'm more worried than the average. I'm more worried than the average because of the dynamics of the war. It's an asymmetrical war. You have 3 parties, now 4 parties, all of whom believe they're winning, which makes it very hard to end this war. And the US is the only one that can declare victory but can't impose outcomes. And I also look at the economy, and I'm starting to see demand destruction that can accumulate. And if you go to Asia, they're not just worried about higher oil prices, they're worried about actual physical shortages.
Right.
And that is another tipping point for the global economy. So in general, I've gone from reduced risk to maximum risk off to now a few names look attractive, but I would not be going into the market and buying the index at this juncture.
When you talk about demand destruction, Asia is talking about shortages. Demand destruction is happening elsewhere outside of the United States. We might be a long ways off from demand destruction. So how insulated can our economy remain, even if elsewhere in the world there is sort of this greater impact?
So we win in relative terms under virtually any war scenarios.
But relative terms don't mean that much to the average consumer or to the markets, maybe.
Right. But so the question is in absolute terms. I think there's no doubt that we are going to have not just an energy price shock. In my mind, we're going to have an inflation shock. Secondly, we are likely to see that inflation shock translate into less spending, particularly for the lower income households. So there will be a demand effect. If this continues, so you start with energy shock, interest rate shock, broader inflation shock, demand shock, then if this continues, which I hope it won't, we're going to be talking about financial instability. So that's the sequence. Hopefully we don't go all the way down, but that's the sequence that's been triggered by this war.
$200 barrel in oil. Amongst energy watchers, that had always been sort of the outlier scenario, but that outlier scenario seems to be moving a little bit closer and closer as this conflict continues, particularly because every day the war goes on, there's an increased chance that there's going to be terrible damage to infrastructure, which would create this longer shock to happen. So how do you think about that in terms of what that would be? Would that be the systemic shock that you're talking about? Would it have to be that dramatic?
So the first tipping point happened at the end of the second week when we went from disruption to damage. Damage means the tail is much longer.
Yeah.
And you heard Qatar come out and say 17% of its LNG exports have now been disrupted for 3 to 5 years.
Yeah.
There's also been damage in UAE, less so, but there's been damage, and there's also been damage in Saudi, less so, but there's been damage. So that's the first tipping point. The second tipping point is when we started seeing attacks on other infrastructure. So aluminum was an example over the weekend. That has resulted in a 6% increase in price. And we are starting to realize it's not just about oil, it's about fertilizers, it's about helium, it's about aluminum. There's a whole list of things. So I do worry that we are going to go to a broader shock. But the next tipping point economically is actual physical shortages. If we start seeing that in Asia, that will impact the US. So the US will now import higher products in terms of prices. And the question is, do we now see also a disruption in the availability of products?
So in terms of what markets are not pricing in, do you think that it's, I mean, last week at CERAWeek, a number of executives, including Mike Wirth of Chevron, had said that the oil markets are not pricing in what is going on in terms of the disruption to energy. Are we not pricing things in equities? Are we not pricing things in energy, in the bond market? I mean, where do you go?
So you heard earlier, there's a massive differential between the physical price of oil right now in Asia, 140, 150,
Right.
and futures.
Sure.
Okay, at some point, you need convergence to happen. Equity, we still have this mindset that this is transitory, that somehow, yes, there's going to be a short-term effect, but we should look through it. And then the third thing we're not pricing in is there's very limited policy flexibility. We've been bailed out by policy over and over again, whether it was the Fed flooding liquidity or whether it was the fiscal. We don't have those degrees of freedom anymore. There's a real question mark as to what the Fed is going to do, and we're already running a 6% deficit. So the market hasn't quite realized that if this goes on, the policy offsets much less than what we've had before.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.